Welcome to the Source of Commercial Real Estate, where we discuss all things non residential commercial real estate, including finding and funding deals, seeking opportunities, and discovering your competitive advantage. I am your host, Jonathan Hayek, and today I am talking with Chelsea Mandel. Chelsea is the co founder and managing director of Ascension, a corporate real estate advisory firm that accelerates the pace of progress to achieve a higher standard of sale leaseback advisory. Having structured over $1 billion in sale leaseback transactions on behalf of private equity firms and middle market companies, Chelsea and her team of advisors work specifically with financial sponsors, helping provide corporate real estate and sale leaseback solutions for existing portfolio companies, as well as acquisition targets alongside merger and acquisition processes. Chelsea, I'm hoping you are going to be able to help me explain what exactly I just read.
Yes, absolutely. And thank you for having me. Excited to be here.
Of course, I am grateful that you are taking your time out this afternoon to have this conversation with me. How are you today?
I'm good. I'm
Aw-
feeling good. I'm ready.
Awesome. Really looking forward to this. Chelsea, why don't we start out with you telling us about your background, how you got started in real estate, and what your work in real estate looks like today?
Yeah, absolutely. So, yeah, I mean, my career trajectory has been a little bit unconventional in terms of, on the real estate side, I did start on the investment, buy side, and obviously now I'm working on the sell side in an advisory role. So directly out of college, I started at Starwood Capital Group, which is a, traditional real estate private equity fund, working across all different asset classes, mostly through value add strategies. And so I was specifically, in the analyst program working on multifamily and retail value add deals, and was living and working in Greenwich, Connecticut. I was there for about 2 years, and then I moved over to a private equity fund, just middle market private equity in New York, a company that was called New Mountain Capital. They were buying businesses, so not in the real estate world really at all. This was the firm's first real estate strategy, but they had a credit arm. They also had a hedge fund and a private equity arm, and they were looking to expand into real estate through a sale leaseback strategy. So specifically a net lease investment fund where they'd be buying, sale leasebacks from other middle market sponsored businesses. And so they were looking to launch this fund. And, basically I was the first employee hired under the portfolio manager to help get this strategy off the ground. So it was really exciting, super entrepreneurial. I was really 2 or 2.5 years out of college. So it was still pretty, I was still pretty green, and this was a really exciting opportunity to build something from the ground up. So I, took on that opportunity. I moved to New York, to the city, and I joined that fund. In the beginning, first couple months, we were pretty much just fundraising and, getting our LPs into the fund so that we can go out and start doing deals. So I was building a lot of the templates that kind of form the foundation of the fund and ultimately the strategy. So all of our models, our IC memos, really putting together the process for how we were going to transact in these sale leasebacks, when we can go out and start doing deals alongside, again, fundraising with the LPs. And so it was a little bit, simultaneous. We were fundraising while we were trying to tie up deals, because I'm sure, as everybody knows, it's easy to fundraise when you actually have something to offer in terms of an opportunity. So yeah, I mean, long story short, I was there for about, just under 3 years, bought about 400 million or so in sale leasebacks. We raised a $500 million fund. I think the fund's on fund two now. And yeah, it was pretty much all industrial sale leasebacks at the time with private equity owned businesses. And this was my first, exposure at all to sale leasebacks. I really hadn't heard of the strategy at Starwood, where I was, again, doing more kind of traditional real estate private equity. And so it was interesting to me. I had a number of friends in private equity. I had friends in banking. I had friends at credit funds, all kind of around, the operating business side. And this was kind of an interesting opportunity to put together what they were doing on the credit and the operating company side with the real estate exposure that I had at Starwood into this sale leaseback strategy that is pretty much a marriage of the two, of credit and of real estate. So it was, very exciting to learn something new, to be a part of something new. And then ultimately, when I left, it was really just to kind of take the next step in, my entrepreneurship journey and move over to the sell side to an advisory firm. So I joined a brokerage firm called Stream Capital Partners that was based out of Chicago. I opened their New York office. and really just wanted to get my feet wet in terms of, being on the other side of those transactions that I was buying before, and advise business owners and advise sponsors on how to set up, this sale leaseback solution to really help the company, the operating company, optimize their footprint, generate capital that they can redeploy into some higher and better use. And working with companies was really exciting. You see a lot of different things working with sausage manufacturers and metal fabricators and precast concrete manufacturers, really all across the spectrum. And so, I was with Stream for about 3 years. I did about $1 billion in sale leasebacks, both representing business owners directly, so family and founder owned companies, as well as private equity firms with their portfolio companies and add-ons, both with existing real estate that they already had in their footprint, as well as structuring sale leasebacks in conjunction with M&A deals. And so, like I mentioned, I was there about 3 years when I, again, that entrepreneurial itch kind of started to come up again, and ultimately I left last January, and not this past January, but the one before, and started Ascension last April. So we're kind of coming up on our 1 year anniversary here. So that's a little bit of my story and my background.
Incredible background. You got so much experience so early on, and I'm sure you had just a ton of opportunities to learn from mentors and learn from people that have been in the game for a long time. Your career really could have taken you anywhere. You could have gone into finance and investment banking and all kinds of non-real estate stuff, but you gravitated towards real estate. Can you explain that? Why real estate?
Yeah, I mean, I think it's a little bit of probably what most people in real estate say, which is like it's easier to understand, it's tangible. You're dealing with something that you can see and touch, and it just kind of brings this, hypothetical like corporate finance to reality. And I like that. I'm a pretty black and white person. I like understanding, what it is I'm working on, not in the hypothetical, but in the reality. And so I think that component of it, was interesting to me, but pairing it with the corporate finance and the hypotheticals of, cap stacks and, just other kind of more financial concepts in private equity or in investment banking, I think is really what kind of got me, interested in how we can pair those two together.
Absolutely. Yep. You obviously have a ton of skills on the finance side. And so marrying that with the real estate seems to make a lot of sense. So describe what Ascension, you're now almost 18 months into Ascension. Describe what have you created? What are you working on now?
Yeah. So just to clarify, about 12 months in. So we're coming up on our 1 year anniversary.
Oh,
But yeah, I mean, we have, a fantastic business, a fantastic team. We're staying in our lane. We're doing what we do best, which was what I was doing before, in my advisory career at Stream. We're focused on sale leasebacks. We're focused on corporate real estate. We're representing, again, both sponsors, private equity in M&A deals, just with existing real estate, and family and founder owned businesses, helping them, optimize their real estate footprint, helping them optimize their balance sheet through this, corporate finance tool through a sale leaseback. And we're seeing a lot of interesting deals. I mean, we're working on a lot of, interesting transactions with businesses that have been around, 150 years, where we're working with the CEO whose great great grandfather, started the company, or we're working with private equity businesses in very short time frames where they're, using the sale leaseback to basically finance that M&A deal, or to, create a large majority of the cap stack. And so we're under timing pressure, and there's all these, kind of moving pieces that you have to make sure fit together really nicely to be there at the closing table for your client when they need to close a transaction. So it's been extremely exciting. We've closed about, I think, around, 600 million or so in sale leaseback since we started. I would say probably 60 to 70% of that is in the industrial space, with the remainder, between healthcare, retail, medical, office, or like other kind of specialized assets. So it's been, yeah, it's been really great, really exciting. We definitely hit the ground running pretty quickly after launching, and the market has continued from an activity standpoint to be really strong. Obviously, given everything that's going on in kind of the broader macro market, we've seen volatility, we've seen pricing, we've seen lease terms change a bit. But from an activity standpoint, the team's been busy.
let's take a step back. We've been throwing around this phrase sale leaseback. Experienced investors are going to understand what a sale leaseback is, but people just starting to learn about real estate, that phrase is not going to be familiar. So
Yeah.
when people say sale leaseback, what are you talking about? How do you explain that to people?
Yeah. So just to really break it down into the fundamentals, what you're doing is you're taking a piece of real estate, that your company, your operating business operates out of. You're selling that real estate to an investor that we would bring in, and you're entering into a long-term lease so that you continue to, as the business, retain control, possession, occupancy, operations of that facility, but you get all the cash from the sale and you become a tenant going forward. So it's basically converting you from an owner operator into a tenant. And the benefit is that you now have all this capital, typically at an accretive cap rate, that you can redeploy into some higher and better use. So invest it back into the operations where that has an ROI associated with it versus just owning real estate that's sitting on your balance sheet, not earning a return, or using it to buy equipment that can generate a return, for your operations, or funding an add-on or funding a new store. It's just an accretive way of generating capital that typically the business will want to reinvest back into the business versus having it tied up on their balance sheet.
And it's a really interesting idea from the real estate investor perspective, because as real estate investors, we're like, why would you not want to own your real estate?
Right.
Why would you want to be a tenant? But you explained it really well that it's kind of the same explanation that I go through with when people want to understand net leases, like someone like Starbucks. Like, why doesn't Starbucks just own their real estate? Well, these companies they're not real estate companies. They're in the coffee
Right.
business, or they're in the manufacturing business, or they're in the whatever business, and real estate is not their game. Their expertise and their money is better deployed elsewhere, going back into their business. Did I summarize that correctly?
Yeah, absolutely. And a lot of the time too, for private equity, like it just also doesn't meet the return thresholds that they need for their investments. They can get a much better return investing that capital into the operating company than owning properties that a lot of the time could be in the middle of nowhere. And for the investors that we bring to the table, that's okay because they're not relying on asset level appreciation like you would at Starwood or at a, traditional real estate private equity fund. Rather, they just want the cash flow. It's really more of a credit strategy for them to get this long-term stream of cash flow from a business that they believe, one, has a reason to exist, and two, will exist in this facility because this facility is so mission critical to their operations.
Let's talk about asset classes and markets. I think you said that Ascension focuses 60% on industrial and the remainder on medical and various other asset classes. Can you talk to me about Ascension's strategy? Why industrial? Is that just kind of the low hanging fruit? That's where, the light manufacturing and things like that are? Or does Ascension have some competitive advantage in the industrial space?
Yeah, no, that's a great question. It's actually something. So those stats came out of our private equity sale leaseback survey that we took last year, where we basically polled our private equity clients, and just in private equity specifically, we said, what asset classes are you doing sale leasebacks in? Which is the most likely for you? Is it industrial? Is it retail? Is it healthcare, medical, whatnot? That's what we found, and that's what we found when we look back at our track record of closed deals. But it's not a proactive focus. Like we do deals in every asset class that makes sense for a sale leaseback. We wish the numbers were more evenly distributed because I do think the value proposition and the opportunity set is pretty equal. I think the fact that we're doing more in industrial is more a function of what our clients, like what our private equity clients specifically, are focused on. They tend to be buying, manufacturing businesses, distribution, business services. It just tends to be the asset classes that they're focused in. But we will do, any asset type, any location throughout North America, so US, Canada, and Mexico, and Europe. And we'd love to see more in, more esoteric asset classes. We've done deals in foundries. We've looked at quarries. We'll do land deals. It really just has to be, again, strategic to the business that operates it and something that the company can commit to for the long term.
Those deals that you're doing outside of the United States, are those typically US owned businesses or not necessarily?
Yeah, that's a great question. Honestly, not necessarily. It's probably 50-50. I mean, we definitely work with, businesses that have a global footprint, but we also work with, mostly on the private equity side, we work with sponsors, in London or in Germany or, throughout Czech Republic, really wherever. And they just happen to, also own businesses that are kind of across Europe more generally. And for Mexico, I would say it's mostly US sponsors that have, a Mexican manufacturing footprint. But in Canada, it's both. It's US based groups that have, North American based footprints that include Canada, but it's also we work with a number of Canadian businesses and also with Canadian sponsors.
Was that something you took on with Ascension for the first time? I'm just thinking it seems like going international just seems like a huge hurdle to overcome. Just learning,
Yeah.
different lending laws and tax laws and different ways of doing businesses all across the world. How did you get into that strategy of going outside the United States?
Yeah, no, so it's really interesting. It kind of fell in my lap on the first deal, which was, an existing client came to us and said, we own a manufacturing facility, in the auto kind of OEM space in Mexico. Can you help us with it? And I was like, I don't know, can I? Like, let me try and figure this out. And I'm just pretty resourceful. And, the biggest thing for me is I want to be a resource for my clients. I don't want them to have to go elsewhere. With that said, I'm only going to stay in my niche of sale leasebacks and corporate real estate advisory. But if there's anything in corporate real estate advisory that we can figure out, I want to figure out and I want to be able to provide, a solution. So I kind of just took it on my own to say, okay, how can we do this? And the way we do it now with, outside of the US opportunities is we have local partners. So we'll either work with them on like a broker of record basis for compliance and local market intel, translations if we need to translate to a different language. And then all the regulatory, requirements of local law for leases and for lending and, all of the kind of nuances of that jurisdiction. We will work with those local partners either in a more robust way where we're also working with them for like marketing where they have potentially local investors that may be interested in the opportunity or just from like a regulatory and compliance standpoint. And so that's really how we've been able to provide that global offering for these clients, which for most clients, we're actually working with them across multiple jurisdictions. It's not just US, it's not just, UK. We're working with them kind of all across their portfolio companies or all across their businesses that do have these global footprints. And so it was really challenging for the first couple of deals, in different jurisdictions. We were definitely getting used to things. Like, for example, in Germany, like we had to totally change our marketing materials in terms of the timeline because the timeline is roughly the same, but then there's this German preemption right where the government essentially has a 4 to 8 week period, like almost like a ROFR. Like they get a last look on deals. They rarely ever execute it. But what it means for the client is that the client is not going to get the cash for 4 to 8 weeks after you close. And so when you're, setting expectations with your client, especially if you're looking at this like as an M&A deal, you can't really do it as a simultaneous sale leaseback because you don't know when the government's going to waive that right and when your client's going to get the funds. So there's a lot of nuances like that. Like in France, you can only have leases that are, 12 years. You can't have anything longer. There's like penalties. So there is a lot of local jurisdiction and a lot of local nuance in terms of the law. But you work with the right partners, then you also kind of start picking it up. You can advise your clients in conjunction with your local partner to provide that, holistic service offering for them. So yeah, I mean, we've done deals in a number of different, interesting countries throughout the world, really throughout North America and Europe. And we've learned something new probably every time.
For me personally, in my investing, I've been doing research into the sale leaseback strategy. It was fairly new to me up until about a year ago. And I found that 2022 had the highest number, both the number of transactions and the volume of sale leasebacks in history since sale leasebacks have been recorded.
Yeah.
So, do you have any insight or explanation for this? Why has the strategy gotten so popular recently?
Yeah, I think it's a couple different factors. I think first of all, sale leasebacks have come into the mainstream, like completely. Point blank, they are a mainstream, product that sponsors and businesses take advantage of. Whereas, 10, 20 years ago, it was really a product for distressed businesses where it was like a lever of last resort, if you will, to tap into liquidity, generate capital for businesses that were struggling. Whereas now, businesses and sponsors have realized it's not that. There's no negative connotation associated with it anymore. It's purely a financial tool in your tool belt, just like anything else for, a creative redeployment of capital into some higher and better use. And if it's just, financial arbitrage for the sponsors, that's totally fine. A lot of our clients do a sale leaseback, take a dividend, return capital early, and it's great for returns. And it has completely come, into the mainstream. In terms of 2022 specifically, I think a lot of it probably was also just like volatile debt markets, credit markets, difficulty getting access to capital in other more traditional forms of financing, like traditional term loans. Lenders really pulled back. For the M&A market, they said, I'm going to lend half a turn to a full turn, lower leverage, and that leaves a gap in the financing and in the cap stack for a lot of this, middle market sponsor businesses where we play in. So I think the volume of activity was a lot stronger for sale leasebacks, not because it's a distressed tool, because again, it's not, but because other lenders were pulling back and being more conservative than our sale leaseback investors were being, and our investors were providing that liquidity when maybe other lenders were tightening a bit.
Yeah, great explanation. Chelsea, tell me about the value that Ascension brings to your clients. If a firm wants to sell their real estate, why would they not just list it with Marcus and Millichap or CBRE or whomever and put it up on Crexy, send an email blast?
Yeah.
What value does Ascension bring that differentiates yourself from maybe some of the larger brokerages that could do a sale leaseback?
Yeah. Well, I think exactly the way you just said it at the end there is a lot of brokerages can do a sale leaseback, but they don't specialize in sale leaseback. So if you're, and we never want to put down any of our competitors, but a lot of the, competitors out there are kind of like a one-stop shop. They could do some leasing, they could do some sales, they could do some tenant reps, some sale leasebacks, but it's kind of a diversified real estate offering. Whereas we don't go about it from the real estate perspective. We go about it from the corporate advisory perspective. So if you're a sponsor, we can help you look at, lease rates in a market, tell you if these are at market, tell you if these are crazy, get you a comp set. We're happy to do all of that because it falls into the category of corporate real estate and owner occupied real estate. But for what we do, we're specialists. We absolutely are in a niche, part of the real estate and credit market. We stay in our lane. We want to advise businesses and private equity clients on corporate real estate strategies. So sale leasebacks, tenant, lease structuring, M&A processes, how the real estate fits into the cap stack and financing opportunities there. And this is all we do. Our bread and butter, sale leasebacks, corporate real estate. We're going to advise you better because this is all we do. I can't offer, other leasing services or, I'm getting really deep in the weeds on just what I focus on. And so what that means from a leasing standpoint is I'm not structuring third-party leases, on my day-to-day. I'm structuring sale leaseback leases. I'm working in the middle market. So when I work with a sponsor, I'm particularly paying attention to things that matter to them, things that are nuanced for sponsors, things like change of control language, because they're going to sell their business and what happens to the, acquirer of that company in terms of the lease, in terms of landlord consent, assignment language, alterations. Like we want to make sure the operations are not being interfered with. We want to let the business do what it needs to do. We don't want to have to get landlord consent every time we want to, knock down a wall or do something like that. Or, in the context of an M&A deal, right? We need to understand all of the other moving pieces of their transaction, of the broader M&A transaction that we wouldn't expect just, any local agent who does leasing and maybe sales to be able to work within the confines of a sensitive, discrete M&A transaction where a client of ours is buying a large company and the sale leaseback is only a small component of that. So it's really just being a specialized niche player in what we do best that allows us to be so great at what we do. You wouldn't come to me for just leasing, your office building in the middle of, I don't know, Minneapolis, right? You come to me when you have a sale leaseback opportunity or when you have a corporate real estate question. And specifically, again, in the middle market, that's really where we play.
It makes a lot of sense. And it comes back to a lot of things in real estate and business where you just need the right partner to help you accomplish the right job. So, yeah, just like you said, if you're trying to, craft a lease to a mom and pop tenant or something, you're not the person for that job. But for the sale leaseback strategy, that is your domain. I was listening to you on another podcast where you were talking about an experience where I can't remember the details exactly, but you were advising a potential client who was considering a sale leaseback. and the current market just didn't match up with that client's goals. And so
Yeah.
you actually advised that client to actually wait. That now is, for what you're trying to accomplish, now is probably not the best time. If you wait until whatever, there's adjustments in interest rates, or you can fix your financials, or whatever it is, waiting could be in the best of your interest. Can you talk a little more about kind of how you work with your clients and advising them? Because you're not you're not in it for the quantity. You're not just trying to rack up tons and tons of listings. And there are some
Right.
brokers out there where that is their game. It seems like you are in it for the long haul, and in it to build a relationship, and in it to try to help these firms get in the best situation. So, can you talk a little bit more about that?
Yeah, no, absolutely. And I think a lot of it comes down to the fact that we view ourselves as an extension of your team. If you're a client of ours, we're your corporate real estate team, right? Your team is not getting deals all the time. Maybe your team gets deals, 50% of the time when it makes sense. Maybe we pass on some deals. Maybe you pass on some deals. We're really a partner. We're in it for the long run. 90% of our business is work in the private equity space specifically is recurring, repeat, long term business. And we don't achieve those numbers by taking on any opportunity that falls in our lap. Not a lot of the time, but sometimes we say no. If we don't think we can meet your expectations or achieve your goals, I would rather say no, thank you, or here's an alternative situation for you to look into than take on an opportunity where I'm not like 90% plus confident that I'm going to over meet your goals. I am a huge believer in under promise, over deliver all the time. And if we can't get there by offering our solution, we'll tell you that because we're a trusted partner. We're, like you said, we're not in it for that one deal. We're in it to build a relationship. And so if our taking on an opportunity we know is only going to lead to one potential deal that we're like swinging, for the hills for, and we don't even think it's an opportunity that we're that confident in, we won't take it on because we're not going to risk losing a potential partnership and a potential long-term repeat client for one deal. It's the difference between being a transactional broker and being a trusted long-term partner. So we'll take on, opportunities where, a sale leaseback doesn't make sense because the business's financials can't support a market rent to get them to a market valuation. And what we'll do is we'll offer them like alongside again the corporate real estate financing solutions, we'll offer them a capital markets execution where our capital markets team will go in and get them, like a bridge loan or, some short-term debt facility for 36 months while they turn around the business. They, achieve financing through that mortgage route. But we have advised them that, look, in 36 months, if you can execute on your turnaround, the company would be much better positioned for a sale leaseback then. So we help them get the financing that achieves their goals now, but provides that long-term flexibility that they could then get out of when they do want to achieve a sale leaseback if it makes sense at that time. So we'll put in place situations where, or structures where they're not going to be in a difficult situation in a year from now. They're actually going to hopefully come back to us and thank us for putting them into that structure in the first place.
Yeah, great explanation. Makes a lot of sense. Let's talk about buyers. And I understand that your business model is focused mostly on sellers. But tell me about who is buying your deals, and can
Yes.
you differentiate between? You've talked about some of your clients in an M&A situation versus private equity versus you also mentioned working with family founder situations. So
Mhm.
can you talk about who 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 is your ideal buyer for these deals?
Yeah, no, that's a great question. So we certainly only represent, our clients, which are business owners and sponsors, but we maintain very important, relationships with our buyers because knowing what they're looking for and what their goals are in terms of, buying opportunities, it really helps us align goals with opportunities that we're working on, on behalf of the seller, where we can maybe in an M&A situation need to go off market or in an expedited fashion, knowing that we have buyers for certain things for specific opportunities, we can be much more nimble, we can move much more quickly, and we could do it in a discreet, expedited fashion. So it is very important to us that we maintain strong, investor relationships. In terms of who we're actually working with on the other side of the transaction, the biggest factor comes down to, well, two things: one, credit, and two, size. So at the larger end of the size spectrum, we're typically working with pretty sophisticated, institutional investors, whether they're sale leaseback specific or asset type specific. It could be real estate private equity funds, it could be public REITs, sophisticated larger family offices, it could be asset managers, it could be the sale leaseback arm of some, multi-strat asset manager, et cetera. It's basically, investors that want to buy long-term cash flowing, income producing properties. Again, typically with a credit approach, they're usually looking at the credit first, the real estate second, meaning they want to get at that underlying business, the operating company who is the tenant, and collect that long-term stream of cash flows. On the smaller end of the spectrum, I would say like sub $10 million deals. That's really where we're dealing with more of the private capital universe, which we maintain a tremendous, network of. So those are investors that are, private, high net worth individuals, 1031s, family offices. The 1031 market is obviously super strong on the smaller end of the spectrum, because if you find an opportunity that fits their requirements, a lot of the time they could be an outlier bid and pay more for that opportunity because they're trying to avoid their capital gains tax.
Great. So you mentioned earlier that you've seen some changes in lease terms and deal terms and what buyers are expecting. Can you walk me through, kind of piggybacking off of your last answer, what changes are you seeing in the marketplace in terms of buyer expectations and seller expectations, for that matter, in order to get deals done?
Yeah. I mean, I would say one thing I'm thankful about is it seems like the buyer seller gap has narrowed a bit more in our space than kind of in the broader like M&A world. Like when we talk with private equity clients and, investment bankers and others in the M&A world, it sounds like the bid ask spread is still pretty wide in terms of sellers, getting aligned with kind of the new market. But in the sale leaseback world, it actually feels like everybody is kind of aligned, or we're just doing a really good job of managing, expectations on the seller's behalf. But, in terms of changes in the market, I would say, you know, cap rates have gone up just like across, when you look at it kind of in the last couple years, cap rates are higher now than they were 2 years ago, but they're actually lower now than they were like earlier this year. So they definitely ebb and flow. But I think overall, like big picture, over the last, 12 to 18 months, cap rates have probably gone up, 100 to 200 basis points. And it varies based on credit, based on location, et cetera. But I think overall, cap rates are higher now than they were, 2 years ago. So that's, the biggest thing in terms of pricing. But I think what you've seen on the flip side is with such aggressive inflation, like pricing has risen and rents have gone up, and rent growth has, been very aggressive over the last couple years. And so when you look at valuations, which you could basically look at in our world in triple net, absolute triple net, you're looking at rent divided by cap rate, that's pricing. So if your rents have gone up, but your cap rates have gone up, you're applying a multiple to the numerator. So typically, you're actually not seeing valuations very different from an absolute dollar perspective, because the outsized effect of the rent growth versus the increased cap rates. So I mean, we look at plenty of deals where we've underwritten these deals a year ago, 2 years ago. The seller is coming back to us for a refresh, and pricing is not that different. It's just a higher cost of capital now. So it's just something that you have to manage, in terms of kind of the new norm. But you're seeing interest rates up, 400 plus basis points in kind of the broader lending market. And when you compare that to the movements in cap rates haven't moved as aggressively. So that's one point. I think in terms of lease terms as well, again, given inflation, you're not as much seeing like a 2% annual rent escalator market as you were, I would say like a year ago, where that was pretty standard. We're doing a lot more deals with 2.5%, 3%, 3.5%, and even, better markets. So that's a term that's definitely changed. And then, yeah, I think just alongside like the broader, flight to quality that typically you see in volatile markets, I would say more challenging credits and hairy credits, deals that negative EBITDA that we could have gotten done in 2021, for example, where, it was obviously just a great year and tons of capital chasing these deals, may not be executable or actionable now, right? So we're still doing deals in the lower middle market, but it's really just those super hairy deals that I think are kind of just a no-go for now that we've seen, different from where we were kind of 2 years ago.
Talk to me about analyzing the credit of a potential tenant or seller in this situation. So, for someone, maybe an investor considering the strategy or just considering a new tenant, what sorts of things do you recommend investors look at when they're analyzing the credit of a tenant?
Yeah.
And along with that, what red flags should stick out to a potential investor?
Yeah. So, I mean, you can pretty much gather what you need by looking at, like 3 to 4 years of financial statements. So, we look at credit very similar to how a traditional lender, what their credit lens is. So, we look at, what has the business been doing from a trend perspective over the last couple of years? How did they get through COVID? Obviously, we understand COVID and we understand industry specific things. If there's rising chicken costs or labor costs or the chip shortage, semiconductor, supply chain issues. Like we understand kind of with a great level of nuance because we're so active in the middle market. We kind of understand the themes of what has gone on in different industries and different sectors. And we take that into account when we understand, and underwrite financials. But we look at typically, again, 3 to 4 years, P&Ls, balance sheets. We're looking at their margins, what have not just the numbers done, but what have the margins done? What do their EBITDA margins look like? We look at, obviously profitability. We look at what's going on at the top line. Have they lost any big contracts in the last couple of years? If it's that type of business, we look at, is there any like major customer concentration? What is their top 10 customers responsible in terms of, responsible for in terms of profitability and in terms of revenues? We look at what's their end market exposure. Is there cyclicality in their industry? So really all those factors, in terms of the balance sheet and their capitalization, obviously we're understanding what is their leverage, how much equity do they have in the business, like what's their skin in the game, is the business over levered, not just like what amount of leverage, but how expensive is their leverage. So we look at things like fixed charge coverage ratio. We're pretty attuned to the financial metrics that are important to sale leaseback investors, which have a very, again, like credit focused hat on when they look at these businesses. Red flags would be, a tremendous amount of leverage. If the company's 9 times levered and they want to do a sale leaseback, your question should be, great, are you using the proceeds to pay down debt? Or if they have almost no equity in the business, or the sale leaseback proceeds would take out all of their equity in the business if they kept it as a dividend, maybe you should be a little bit concerned. If there's a ton of concentration in their customers and they lose one contract, that would be a red flag. Is the other things like, is the business revenues, like, is the majority of it recurring? Is it aftermarket, like maintenance based? Does it rely on, like what's going on in the government? If it's government contracts, defense related, things like that. So there's a ton of nuance in going through financials. And also, like, we typically like to see like some sort of a investor presentation or management presentation or lender presentation just to understand the business a bit more. But you can pretty much gather what you need from looking at the business, very similar to how their lenders probably look at their company.
Chelsea, I know the last 12 months or so has probably been a whirlwind for you as you have ventured out on your own to start Ascension. And I'd love to spend a few minutes talking about this new endeavor. So tell me on a broad sense, as you've gone out on your own to start Ascension, what have some of your biggest takeaways of the last 12 months been?
Ooh, that's a good question. Um, I would say like you probably underestimate a lot of things, like how much work goes into like the back end, like the stuff behind the scenes, getting things set up and like ready to launch, getting all your systems in place and your like payroll, legal, accounting, all the stuff that you don't really have to do as somebody who works at another company, but as a business owner, keeps you up at night. Like, is our accounting in line? Or, is our CRM system, capturing everything that we're doing? Are our reports accurate? Are we tracking the right KPIs? Like, what does our budget look like? Like all the things as a business owner that I think you just really don't have to worry about, even as an independent contractor with another company, because you're just not worried about it. Your P&L is basically like your revenues and your personal expenses, but you're not doing any of those things that the house or the brokerage firm is responsible for. I think that was the biggest realization for me, was that it's actually a lot more work going out on your own, even though I felt like I was kind of running my own business, even working at Stream, because I was an independent contractor. I had my own clients, I was paying for a lot of my own expenses, but nothing will compare to actually running, your own company.
So, what's been your philosophy? And I'm sure it's an ongoing process, but how have you been able to overcome that stuff? I mean,
Yeah.
is it have there? Yeah, has it just been sleepless nights, or has it just been, you know what, I'm just worrying about the big rocks, or what? What learnings have you taken away from having all those challenges?
Yeah, I would say putting people that you trust in positions, to actually make decisions and to give them a voice and not just like yes you, but actually tell you, when you're off base with something or something that you need to know that, maybe someone else would sweep under the rug, like just putting people into positions where they actually can be empowered to tell you what you need to know, not just what you want to hear. And then meditation, I started meditating. I have my own little meditation Zen situation in my office here just to, you know, not let the small things really like make an impact and kind of just let them roll right off because a lot of these things are just a lot of small things. So I think trying not sweating the small stuff, I think is a valuable lesson for sure.
Yeah. I want to talk about the people that you had just mentioned, putting people in the right place, and
Yeah.
you you have a very impressive resume. You've been at some top firms, and so I'd love to talk about how your network has played a role in helping Ascension get off the ground and get to where you are today.
Yeah. Yeah, I mean it's definitely played a role. I think both in terms of my professional, well, three, my professional network, my friends and family network, and my alumni network, I think for sure have all been pretty meaningful. Having gone to Dartmouth, we have a pretty big contingency in private equity and in investment banking as well as in real estate. And so I think having that alumni network has definitely created opportunities both for business development of like directly working with other alumni at their private equity firms or that are business owners that we've worked with on the sale leaseback side, but also working in conjunction with them, like investment bankers in the industry who have made, fruitful introductions to other players or to investment, professionals that are buying our sale leasebacks. So I think that for sure has been a great, networking opportunity for me professionally. And then, like I mentioned before, having friends in private equity, having friends at credit funds, having friends who can help me, in the early days, like underwrite a business and understand financials and understand balance sheets and credit and leverage companies, et cetera. And then, having like investment banker friends who can help me understand the M&A process and how I can build my process on the sale leaseback side in conjunction with the private equity group's acquisition into the timeline that the banker tells me, here's how, our M&A deals operate. So having friends in those places has definitely been impactful, and I lean on my friends all the time to kind of help me through my professional journey as well. And friends and family, my brother-in-law works with us. He and my sister I'm always brainstorming with, my mom, I'm always brainstorming with, just how can we run our business better, how can we do better, how can we connect better with our clients. I think when you have your own business, people realize how much you care about it. It is like a baby. And so it kind of takes a village to raise as well. I definitely lean on my friends and family for, especially for brainstorming. That's like one of my favorite things to do is to just get the family and friends together and start thinking and how can we improve things. So yeah.
Chelsea, tell me about the most important failure that you've experienced in your career so
Ooh.
far. I'm wondering about something, a lesson, an experience, something that's been transformational to you as a person or you as a business.
Yeah, I think from like just a pure business perspective in terms of, my business in sale leasebacks and corporate real estate, one lesson I had really early on in advising. So when I first joined Stream and I was right out of New Mountain, one of the things that I learned as an advisor running a process was the benefit and the importance of having backup buyers. Because the first deal I took on as an advisor, I got one LOI and I was like, great, let me run with it. And I had come from such a professional, like amazing firm at New Mountain that like we really never signed up deals that we couldn't close. We didn't retrade deals. So I was just like under the impression that everybody had that mentality and that this group who submitted an LOI for this $50 million deal, which was my first deal, like there was a lot at stake. I just figured that they would close because that's how we did things. And they submitted an LOI. We got like a week into diligence and they started asking all these questions that were such red flags that they really hadn't gone through the financials. They hadn't gone through the data room that, as a first like deal, I was so meticulous in creating, they hadn't looked at any of it. And I didn't ask because I didn't know I needed to. I thought I came from this firm that does everything, just like everyone else does. And I was so wrong. And I had to learn the lesson the hard way. I had to explain to the client, we're going back to market. We have to bring in more offers. And since then, I mean, I've never signed up a deal with one buyer. We've always, I mean, obviously we sign them up with one buyer, but not having one buyer in the mix. We always try and get, I would say like at least like 6 or 8 offers so that we can fall back on them. God forbid anything goes sideways and we need to go back to the drawing board.
Really valuable insight. Chelsea Mandel, I am very appreciative and thankful that you were able to spend some time with me today. I learned a ton, and I know you added a ton of value to our listeners. If people want to reach out to you, connect with you or Ascension, where would you like to send people?
Yeah, I mean, I would say email me, chelsea@higherascension.com, or shoot me a message on LinkedIn. I'm pretty big on the LinkedIn platform, so feel free to find me there. It's just my name, Chelsea Mandel. And yeah, thank you so much. This was fun.
Awesome. Thank you. Have a great day.
You too. Bye.
Bye.